Welcome back to the Lucia Capital Group weekly video. I'm Rick Plum. If you're one of the lucky people who own a pension, you may have noticed that before you start receiving the payments, it will offer you a different payout amount. Normally, if you're married, benefits have to be paid in the form of a qualified joint and survivor annuity. This annuity pays a certain dollar amount to you during your lifetime, usually monthly, with at least 50% of that amount continuing to your surviving spouse after you pass. But you can choose to waive the survivor payment and elect instead to receive an annuity for your lifetime only. This could give you and your spouse a significantly larger monthly benefit amount while you're both alive, but the trade-off is that the payments stop at your death. People who want to maximize their monthly retirement income are often tempted to choose this higher-paying single-life annuity for exactly this reason, but many of them are also concerned about providing for their spouse after they die. So how do you solve this problem? One way is to potentially do what's called pension maximization. It works like this. Let's say hypothetically you have an option of taking either a single life payment of $4,200 a month or a joint and survivor option that pays $3,500 a month as long as either of you are alive. Rather than take the lower amount, pension maximization says to take the higher single life payment and use that extra $700 a month to buy a permanent life insurance policy on yourself. If you die first, the pension stops, but your surviving spouse gets a tax-free death benefit to help provide the funds for them to live on. If your spouse dies first, you can either cancel the life insurance policy and keep that higher pension amount, or continue the policy and allow your death benefit to go to your heirs. This strategy can work, but there are also some reasons where you may not want it. Why? Well, in my hypothetical example, the $700 reduction you'd take for the joint and survivor option, that would give your spouse a lifetime pension income of $3,500 a month after you're gone. And that's guaranteed by the PBGC. The question is, could you get a life insurance policy that would be large enough to pay a death benefit to provide that same $3,500 per month for the rest of your spouse's life? Well, sometimes you can, but not always. So using the pension maximization technique may be a great option for some retirees, but you have to carefully consider several key factors before you do it. Factors like the current age and projected longevity for both you and your spouse, your health and insurability, the dollar difference between the single and joint life pension payouts, your tax bracket and financial situation, and whether any health insurance benefits that are tied to the pension go away. Each of these factors and a few others can have a really big impact on whether or not pension maximization can work for you. Maybe the most important first step you can make is to talk it over with your financial advisor, who should look at your individual situation and help you determine what's best for you. We do this all the time, and if you need help figuring it out, just give us a call. We're always here for you.